Welcome to the Medfaber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Medfaber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We have an awesome show today. Our guest is Francois Rochon, President of Giverny Capital, which he started over 30 years ago. Thrilled to have him join us today. Francois, welcome to the show.
Thank you.
I thought it would be helpful for those who don't know you. Maybe let's start pretty broad. Talk a little bit about your philosophy, your framework.
Oh, it's very simple. My goal is to compound capital, ideally at good rates, which I define by 5% better than the index in the long run, and to find a group of companies that we can own for many years that will increase intrinsic value as a whole, aligned with our objectives. So our day-to-day is just looking at all the companies we can find information about. And when we believe that we found a company that fit the criteria, we like their long-term prospects, and the valuation is attractive in the stock market, we'll purchase it. And usually once purchased, we hold them many, many years. I think our average holding period is 8 years. So we're long-term investors, and we like to find what we call compounders, companies that we can own 10, 15, 20 years that would grow earning at, let's say, 12 to 15% annually.
Well, now you mentioned 8 years. I immediately got to ask, what's been the longest term hold in the current book?
It's a good question. Probably Berkshire Hathaway, which we first purchased in 2000, so 25 years ago.
We imagine most listeners are familiar with that one. But it's funny, you're Canadian, and so most of the Canadians I talk to usually get their start in the mining sector. I guess nowadays, I can't say cannabis because that sector's in the tank. But gold, hey, gold's at 3,000, so my Canadian buds are knocking on 3,000 there. But that's not your portfolio. I see things in there like Meta even. Talk to me about how'd you get the inoculation for a value investor? You go back to your start. Was this just reading Value Line in the library? You came across Warren Buffett's speech? What was it?
Exactly. I think the first book I read about investing was Peter Lynch, One Up on Wall Street. And in that book, he explained that when you buy stock, you buy a share of a company. So that was the start of the idea of becoming a shareholder, and companies have value. And you shouldn't worry about the stock market or predicting the economy. And in the book, Peter Lynch talks about Warren Buffett, and he names him the best investor of all time. So I said, well, should learn more about this person. So read The Intelligent Investor, Ben Graham's book, wrote to Warren because that was before the internet. So I sent a letter in Omaha, and he sent me a big book of all the annual reports, I think from 1977 to 1992. And I read that, and really it made a lot of sense to me. And I wanted to be inspired by him. I wanted to start a fund using the investment approach he's been using, in 1992 for the last 40 years or so. And since then, I would say the philosophy has evolved, but basically the principles are still the same. Just finding a great company that has some kind of competitive advantage, good long-term prospects, great management, and that you can purchase in the stock market for some reason or the other at attractive valuation. And you talk about Meta, and that was used to be Facebook. And we purchased Facebook in 2018. There was an issue with the Cambridge Analytica, and the stock went down. And I don't remember the P ratio. I think it was under 20 times when you purchased it. And since then, it has had ups and downs. But I think the stock has probably tripled since we we purchase it. So, and we think that Meta has very, very good fundamentals and strong competitive advantage.
Talk about that experience in the 90s of being a Buffett Lynch style stock picker, asset manager, as the bubble accelerated really in the late 90s, and then, kind of rolled over 2000, 2001. How'd you keep your wits about you? Or did you? I don't know. Maybe you were buying a bunch of CMGI at the peak like I was.
Well, being educated as a value investor in the first years, I was very aware of accounting. Early on, I decided that I wanted companies to have a very conservative accounting. Stock options had to be expensed. And of course, companies have to be profitable. So when the tech bubble happened, end of 90s, early 2000, I had a few companies that I owned for a while, like Sun Microsystem and Cisco System, and Intel also at some point. But we sold it when valuation became too high. So when the bear market of 2000, 2001, and 2 arrived, we were mostly out of those very high-priced, high-valuation companies, and we had purchased insurance companies like Progressive. We purchased Berkshire Hathaway in early 2000. We had other companies like Lynch Holdings, so M&T Bank already in the portfolio then. So we did well in that bear market because we were not in those very, very highly valued companies. So, and of course, I learned from that experience and learned that eventually valuation triumphs. And when a stock is overvalued, eventually you'll come back to earth. But it can take a while, so you have to be patient. So when more recently we do see companies at that very high valuation, well, we have no problem stay away from them because we know what can happen.
Is there like a hard and fast rule for you as far as valuation? I know growth and value are two sides of the same coin, but, as you look through and sift through and screen through, securities and stocks, how do you think about that, being too much, paying up for a multiple or paying up on valuation for a good company?
Well, I was educated also as a scientist. My first education is as an engineer, and then I became a value investor.
Same, you and me both.
So I know that it's not a precise science. It's not an exact science investing. So it's always an estimate of valuation, an assessment. It's not 2 points after the decimal to value companies. And I remember many years ago, I think it was Ben Graham was testifying at some kind of hearing about the stock market. And he talked about, value being a range. And he said, I don't remember the numbers, but just to give you an idea, I think he said this company could be worth something like between $50 and $70 a share. And the person that was interviewing him said, well, that's not very precise. He said, it's not precise, but it's useful. If the stock trades at 80 or 40, it's useful. So I think today it's the same thing. You don't need to be precise when you're evaluating a company. You need a margin of safety. And that's why when we try to value, we were very conservative and prudent. And some companies probably are worth paying 40 or 50 times earnings, but they're rare. They're probably exception. Most companies, when you pay a higher, very high P ratio, discount so many years of good growth that you don't leave a margin of errors. And usually in reality, in the future, at some point, almost every company encounters some problems. And the high valuation is kind of a big weight to carry for the stock. So in the past, I was ready at sometimes to pay P ratio, let's say 25 to 30 times for some, what I believe, very promising growth companies. But I think you have to be prudent. The higher P ratio you pay, the more years you're discounting the future. So the less margin of safety you have. So I have to have the wisdom to know which one are truly warranted to have such kind of valuation, but they have to be exception.
Yeah, I was smiling because I was like, oh, 25, 30, that's cheap for some names in this cycle. Those are rock bottom valuations, Francois. How do you balance that? As you think about sort of company you want to buy and the temptation not to pay up, but also, missing the chance to buy it. I love that you write about your, podium of errors. I like to call mine my failure resume, but, it's long. But, you talk about some of these ideas on both not purchasing something, and we can always look back in hindsight, right? Like that's the benefit, or errors of buying something. Like, how do you balance that? What's the trade-off? And, any good examples you may think in your history, would love to hear them.
Well, in the latest annual letter that we'll send very soon, we talk about the mistake of Cintas. And I think Cintas is a great company in the uniform business. And when they acquired one competitor, J&K Services, 8 or 9 years ago, I was very aware that Cintas was a great company, very stable business, and probably with the acquisition of G&K, they would find ways to have some cost cutting to improve margins. And, I didn't purchase it because I thought the P ratio was a little high. It was about 25, 26 times earnings then. And I think in 8 or 9 years, earnings per share grew 5 times or 400%. So the stock has done even better, but just the earnings per share have grown at something like 17% a year. So, and I missed that because I wasn't ready to pay. It was not a bargain price, but I think it was fair considering the good fundamentals and also the cost-cutting potential they had, the synergy they had with G&K. So that was a mistake. And it's a mistake not only because the company had done well, but also because it was in my circle of understanding, my circle of competence. It's a company I knew, I understood. I was aware of their competitive advantage. I was aware of the great management that was there. And the only thing that, prevented me from investing was a valuation that I thought was a little too demanding, but I should have been more wise.
Look, the reason I'm a quant is my problem is every time I hear a stock pitch, I think it sounds great. But I remember, as I've seen you write about Novo, and I was listening to my good buddy Steve Sugarud years ago talking about Novo. And as a quant, I'm a trend follower and value both. But if I was just left to my own discretionary devices, I love the beaten down, the hated, the non-consensus. And so I remember looking at him talking about Novo and this chart, this beautiful chart breaking out. I was like, it's gone up too much already, And this is years. I don't even know, 3 years ago now, how many hundreds of % ago or whatever it was. But you mentioned Novo too. Is it painful to look at some of these ones, or have you developed a skill to just kind of, I'm at peace, move on, so it goes?
Oh, yes, of course. When you realize you made a mistake, it's never a pleasant experience. You can't be in the business of selecting stocks and, owning 20, 25 names in a portfolio and not making mistakes. That's inevitable. I always say I have this rule of 3, and one of the rule is that one stock out of 3 that you'll purchase will be a disappointment. And, that probably applies the one you didn't purchase also. One out of 3 that you didn't purchase, you should have. So what's important is that you learn from your mistakes. You learn from things that you think you should have done, you didn't do. And when other opportunities will arise, you can be better prepared or more experienced. And that's the great thing with this investment world. There's always opportunities, and there's always new companies that come in or companies that change for the better. There's always things to do, and you have to keep digging and keep looking and always keep an open mind approach also. If a stock you looked at 10 years ago has increased by, 6 or 7 folds, it's not too late for us. You should not avoid it because you've missed the first 600 or 700% increase. If the fundamentals are still good and valuation is still reasonable, it's not perhaps not too late to purchase it. And Peter Lynch talked about that in his book, that you could have purchased Walmart 25, 30 years after its IPO and still continue to do well. So you can miss the first 1,000% of a company, but and perhaps even more importantly, perhaps being a bigger company today, I'm not talking about Walmart, but in general about a company that has matured, perhaps the company is more dominant. The moat is stronger than it was 10 years ago. And in some ways, it's perhaps a better buy today than it was 10 years ago. But to realize that, you have to always study the company and always be open-minded to really watch what's going on with every company you're following.
Well, you said there's two other things in your 1 for 3 description. What are they? So one out of 3 stocks you got is going to underperform. What are the other two?
The first one is that the market will have a 10% correction at least once every 3 years, at the very least. And also, even if you're doing a great job, you'll underperform the index at least 1 year out of 3. And that's just by studying the track record of great investors. You can find that usually if you take a 30-year track record, you'll see that probably 10 years out of those 30, the money manager has underperformed. So you have to accept that's part of the experience of investing. Even if you're doing a great job, if you own great companies, you'll have tough years, and you have years you'll underperform or you'll start in favor. So you have to accept that.
We try to prepare investors for that reality and say, look, all the research has shown the outperforming managers underperform a certain percentage of the time. And yet, despite that, you'll have people after they see 1 year, maybe even, God forbid, 2 in a row, Francois, where they're like, this is broken, I'm going to rotate into. And so there's a famous chart in the academic literature that shows 8,000 hiring and firing decisions by institutions, and the manager coming out, and then the manager they replaced him with, or her, and the 3-year performance before and after. And you know where this is going, but listeners, it's like the one that has the trailing 3-year amazing performance. They buy and they sell the laggard, and then what happens? They would have been better off with the laggard, right?
Yes, and that's just the nature of the business. I don't think we're going to change the world. It's just how most clients, institutional clients or retail clients, look at things.
How do you handle that with your clients? You've been at this for a little while. Do you lock them up for 20 years? Do you say, look, I'm going to try to... You do a great job with your letters, first of all, and I think we've said this publicly on Twitter, where I said if I had to pick one trait of someone for me to give money to in the institutional investing world, it would be humility. And you do a great job of that, again, talking about the errors and 5-year look back. But is education the main way you kind of chat with your shareholders, partners?
Well, I don't know if it's education, but it's really transparency. So we give a lot of information. The annual letter is more than 25 pages long. I think it's pretty rare in our industry. But the most important part of the letter is the owner's earning table, where we show 2 things. The performance of the portfolio, but also the performance, the underlying intrinsic performance of the companies we've owned. And that's important. And that's where I think most investors kind of miss the ball when they look at performance. I think they should try to look at the intrinsic performance of a portfolio. And it's fascinating if you look at that table in the annual report. I think it goes back to 1996. But from 96 to 2024, the companies that we've owned grew earnings per share on average in aggregate at about 12% a year, given let's say a 1% dividend on average. So the intrinsic value of the companies we've owned over the years have grown by 13% annually. And the performance of the stocks before fees and without currency effects has been 13% annually. So there's a direct correlation between the two. So if I was to judge a money manager to whom I would give money to manage. I would look at what's happening to the securities you've owned. So if over, I don't know, a 3-year period, earnings have increased by, let's say, 50%, I mean, the companies have done well. I know that eventually the stock will follow, even if there's been a little bit underperformance. As long as the companies owned are increasing their intrinsic value at good rates or superior rates, eventually the stocks will do well. The only exception you have to be careful is if you overpay for a great company, perhaps you'll have a reevaluation of the P ratio over some years. So perhaps there won't be as much as a correlation between the performance of the company and the stocks. But besides paying very, very high P ratio, I think in the long run, for many years, there's a direct correlation between the growth and intrinsic value of the companies. Again, in aggregate for the 20-25 names you own, and the performance of the portfolio itself. So, but it takes more than a few months. We're talking years. There's a correlation over many years.
You know, Cisco is always the one that comes to mind. I don't know why, when I think of a business that did fantastic for a number of years, but the stock, you know, just took time, a lot of time to work off, you know, that kind of high valuation.
Mm-hmm. Well, I don't remember the numbers exactly, but I think in early 2000, at its peak, I think the P ratio of Cisco system was something 80 times earnings.
Bargain.
Earnings have done well. The following 20 odd years, they've probably grown 8 or 9 or 10% a year. But the stock did nothing for many years because the P ratio slowly shrunk to 15 times. So that's more than 5 times lower. So you need the earnings per share to increase by 5-fold just to get back to the same price when the valuation is much lower. So that's a good example of owning a great company, but sadly perhaps overpaying it at the end of the 90s, early 2000s. So that's a very good example. And I think it was last year or the year before, I don't remember. I think it was in 2021 or 2022. I talked about Cisco and used the example of Cisco for the cost of stock options. Because they have issued a lot of stock options, they bought back a lot of stock. And it was interesting to see that the expense of stock options in the end were mostly right, but there's a real cost in the stock options. So some companies use non-GAAP earnings and remove the cost of stock options. So you look at the P ratio adjusted without the stock options cost, and it's 25, 30 times, so it looks not too bad. But if you expense the stock options, sometimes it can cut 20, 25% of the earnings, and now the P ratio is higher. So you have to be careful there also.
Especially true, I feel like today, particularly with the tech sector, there's a lot of companies that have a lot of stock-based comps. In my home state, California, you see a lot of that going on.
And there's nothing wrong with that. And Alphabet does it and Meta does it. You just have to expense them when you're calculating the earnings per share. If they are expense, it's fine. It's just if they decide the companies will always have the results with stock options expense, but sometimes they will add adjusted second group of earnings, adjusted non-GAAP. And that's where you have to be prudent. Sometimes it's things like removing the intangibles amortization, which is fine. But stock options, in my opinion, are real expenses, and you should not remove them when you're doing your earnings per share calculation and afterward your valuation P ratio when you try to value the company.
It's weird. It's like, how can anyone even argue the opposite, right? They're not a cost, right?
Well, the reason is because it's not a cash expense. I mean, there's no outlay of cash. So that's why usually they say, well, the free cash flow is higher, but there will be some dilution. So the earnings per share, once you divide by the greater number of shares, they'll go down. So that's why you have to take that into account. But since it's not an outlay of cash, some people don't consider them as real expenses. I think they should.
You talk a fair amount about how investors, or at least your approach, you're not paying attention to what the stock market's doing per se. You're not trying to predict the macro outcome of what's going on in the world. Was that from the get-go? Did you learn that by some painful scars in the early days? Or how have you kind of come to this seat of rationality in an otherwise world of most people, you go turn on TV, CNBC, Bloomy, others, I feel like majority of the time, that's the topic they're spending is prognosticating about the future and what's going to happen. How'd that come to you as part of the process?
Well, there's two ways you can learn. The painful way is to make a bad decision and bad experience and lose money. That's a good way to learn, but it's very painful. And the second best is learning from either other mistakes or from good counsels of things you've read and having good mentors in some way that teaches you about important principles. And I was lucky because the first investors I studied in depth were Peter Lynch, Warren Buffett, Ben Graham, Phil Fisher, John Templeton, all great investors, all have different styles. Ben Graham and Peter Lynch and Phil Fisher were very different kind of investors, had very different portfolios, but they had two things in common. But the first thing they had in common is they didn't believe that the market could be predicted or the economy could be predicted. So they just focused on, well-owned great companies, undervalued securities, and then eventually will do well. And the second thing is that they all considered stocks part ownership of a company. So when they would purchase a stock, they would have the mindset of buying a company, the whole company, if they could. And that's the two things that all those great investors that I read in first years had in common. So very quickly, I adopted that investment philosophy. So I never, even in the first year, I didn't try to predict either the economy or interest rates or the stock market, that thing like that. And I decided from day one that I would be 100% invested all the time. Because to me, when you're not 100% invested, in some ways, you're trying to predict the market. And I forced myself to be always 100% invested and to focus on finding great securities for the portfolio and try to be immune from all the macroeconomic talks. And, years have gone by and I'm more and more immune to that, though.
Well, you've done a great job. And talk to me a little bit about 2025. Is it like kid in a candy store? Are you finding good opportunities?
Well, it's the same thing as always. We try to find great companies and try to find companies that we believe are good capital allocators and that the stock look undervalued or fairly valued. It's harder today, I won't lie. I mean, it's harder than, let's say, in 2008 or 2009, where we could find fantastic bargains and people were very pessimistic about the future. A lot of people were exiting the market and didn't want to come back ever. And I remember early 2009, I wrote a piece. I said that was the opportunity of a generation because valuation was so low. We're not there today, that's for sure. I mean, valuation are much higher, but the high valuation are pretty concentrated in the large mega cap of the S&P 500. They've gotten down a little bit recently, but probably at the beginning of the year, if you took Apple, Microsoft, Nvidia, and Amazon, their P ratio was higher than 30 times based on 2025 estimates. And that's pretty high. These are great companies, fantastic businesses, but these are demanding valuation. But aside from those kind of valuation, there's always great companies that trade at more attractive valuation. I mean, one new purchase of last year was Booking.com, which is, I think, a great business. I think it's the best player in the industry if you compare it to Expedia or Airbnb. Airbnb is a very interesting business, but personally, I think Booking is more interesting. And I like the fact that the company is a very good capital allocator. They have a very clean balance sheet and they're buying shares at least 5% of the shares every year. So first, the accounting is very conservative, so all the stock options are expense, but moreover, they have a very strong balance sheet and they buy back stock. And when we purchase it, I think we paid something 18 times earning, which is very reasonable for a company that, to us, at growth prospects of probably, as say, an earnings per share of 12 to 14% annually. So there's always interesting opportunity. Yeah. When we purchase it, I think the main worry of Wall Street that there was a big rebound of travelers after COVID, and probably Wall Street was a little worried that the good growth rate of booking couldn't be really sustained. But so far, the growth rate has continued, and it's been so far a good investment.
And it was booking, I assume, was one that you had in your kind of circle of competence for a while, or were you just kind of sifting through the paper and came across them? Like, what's the kind of screening list, or how do you go about kind of reducing what you're looking at?
Oh yeah, I'd been following booking for many, many years. Probably started with Expedia when it was spun off from Microsoft. I think was 1999 and 2000, and that was the beginning of the we call it travel agency on the web, we could call them. So, and at that time there was Booking, there was Priceline, there was Expedia. And at that time, Booking was probably more concentrated in Europe. But I continued to follow all those companies. And at some point, there was a little bit of change in the business model at Booking, and margins went down a little bit. Of course, there was a pandemic that was really tough. But, when I look at the situation last year, I thought everything was there. I think margins have stabilized. They have become, in my opinion, the best company in the sector. And the balance sheet was very clean. They were aggressively buying back shares, and the valuation was not too demanding. So, compared with the other opportunities I had in front of me, I thought that one fit the criteria better than the others.
How much, as far as casting the net, are you focused predominantly U.S.? Is it a little bit U.S., Canadian, global?
Well, I try to look everywhere, really. We're, of course, a lot of our companies in the U.S., a lot of our in Canada and Europe, China and Japan. So we really look everywhere. Of course, China is a little far. You never know really how the government could intervene in some sectors. I remember looking at Tencent, and I think they changed the rules on video games because they thought they were worried. The government was a little worried that kids could be too addictive, and perhaps they were right. I want to judge that, but there's always that danger in China that the government can intervene, and they have a lot of power. So you have to take that into consideration when you're assessing the risk and the business model of the company you're studying. But BYD has been a huge success in China. It's been it's been a while since I look at it, but it's probably up, 40-fold in the last 15, 20 years. So there's great companies everywhere. I mean, LVMH in France, the owner of the Louis Vuitton brand, I think is a fantastic business, and it's based in Paris, and there's Moncler in Italy, and you talk about Novo Nordisk, it's based in Copenhagen, Denmark. So there's great companies everywhere, and there's certainly great ones in Canada. I mean, our top holding is Constellation Software. It's a Canadian company based in Toronto, and we like their management a lot. Mark Leonard, I think, is one of the best CEO I've ever seen. So there's great companies everywhere, and that's the thing about it. And I always compare my job as kind of a general manager of a hockey team. So my goal is to win the Stanley Cup, to have the 25 best players on the ice, and I don't care where they come from. They can be American, Canadian, Swedish, Finnish, Russian, Slovak. What I want is great players on the ice. That's my goal.
How do you think about Berkshire? Are they trading near fair value for you? Or do you think they're cheap? Or is it something that's just a compounder you think is a core holding?
Well, I think last year was a great year for Berkshire, mostly because of the insurance division that has done extraordinarily well. I mean, Todd Cobb, took the reign of Geico a few years ago and has done an incredible job of improving profitability there. And also the utility industry, the Mid-American energy business, was a little tougher in 2023, but earnings rebounded last year. So they had a very good year. We talk about that in the annual letter, but we estimated that the intrinsic value went up 17% last year at Berkshire, which is incredible for a company that size. Now, going forward, the company has now more than $300 billion in cash, which is probably 28% of assets. So it's going to be hard to compound at, let's say, more than 10% a year when you have 28% of the assets and something that yields, 3 or 4% a year. So that's probably the main anchor at Berkshire. But at some point, they'll find ways to invest that huge amount of capital. And I think if you own Berkshire for many, many years, you'll do okay. Perhaps we can do a little better if we find some younger company that is just smaller, because that's the problem with Berkshire. It's just so big. It's not a question of quality, it's a question of size. I mean, at some point, it's harder to compound 1 trillion of assets. But beside that, I think Berkshire is a fantastic business and one of the best companies in the world, and we're happy to be shareholders.
One of my favorite things you do in your letters is you do a postmortem. You watch TV or talking heads in general, they'll tell you what to buy. Hey, I love the stock, da-da-da. And then they kind of just disappear. And, no one, never are people coming back on CNBC unless they did really well.
Yeah.
In which case they'll come back on and tell you how smart they were who have bought that 1, 3, 5, 10 years ago. But never they come back on and they're like, who's going to follow up on how bad your investment was, a couple of years ago or whatever it might have been. Talk to me about your postmortems. How long you been doing this? It's a fun part of the letter.
We've been doing it for many, many years. I don't remember when we started, but I think we force ourselves not only to look at the mistakes and the podium of errors, but also just to have a regular postmortem 5 years later, what we purchased 5 years ago and how things went. And there's lots to learn, because this year I took the example of Bank of America that we owned, that we purchased in 2019. And at the same time, perhaps 1 year or two before, we had purchased JP Morgan Chase. And at some point, we sold it and kept Bank of America. But when you look at the results of the two banks, JP Morgan has done much better. So that was a mistake to choose to keep Bank of America and sell JP Morgan. And you have to do the exercise. And again, it's not a question of, want to self-inflict pain. It's just that you want to learn. And the goal is to be a better investor today than I was yesterday or 5 years ago. And the goal is even more noble than that. Being a better investor will, I hope, yield superior results and superior return going forward. So there's an objective there, just to become a better investor.
As you hone your skills over the year, what have been some of the Francois learnings over these kind of either the 5-year periods or just the battle scars of being in the trenches for investing in losses and gains and everything too?
I think one main lesson is you have to be very patient, because it takes some years to have the results of good analysis. Every company will encounter some problem down the road. So you have to assess, is this a temporary problem or is it more permanent? And if you believe it's temporary, you just have to stick to the investment and be patient. And the second lesson, which is a little bit similar, but I stress the importance of humility, but I think that's the most important thing when you're an equity investor. You have to accept that you don't know the future. You can't really predict what the market will do, which company will be. When you own 25 companies, like I said, 1 out of 3 will be disappointing, and you don't know which ones. So you have to be humble, and it's such a fast-changing world. It's really hard to know which company will adapt and do well, and those that will miss a turning point. And I come back, and I've learned that also, but Many years ago, when I started to invest, I read a Philip Carey book called The Art of Speculation. And that's a very old book. I think it was written in 1930. In that book, Philip Carey had, I think, 12 rules of investing. And one of the rules was be quick to take losses and reluctant to take profits. And if I look at my experience over the last 3 decades, I try to always kept in mind that rule, but I learned the hard way that it's even truer than what I believe. It's so important to keep your winners. And when you realize you made a mistake or company is not, as expected, you have to be quick to take your losses and just, move to something else and not get too emotional about it. So, but keeping your winners will make a big difference. And I've made that mistake so often. I mean, we own O'Reilly Auto Parts from, I think, 15 years, from 2004 to 2019. We did very well. I don't remember, but let's say 15, 20 times our money. But, since we've sold it, I think the stock quadrupled. So it was a big mistake to sell. We just should have kept it. And, even the big winners in the portfolio, like Visa or Dollarama, we trimmed it at some point when I thought the valuation was a little too demanding, and they probably tripled or quadrupled since then. So you have to hold on to your winners, and that's the key lesson I've learned over the last 3 decades.
I want to talk about another thing you do in your letters, which is called the Baskin-Robbins flavor of the day, sponsored by Baskin-Robbins. You should get Baskin-Robbins sponsor your letter. Get free ice cream for everyone. But anyway, like what's going on in the world that everyone's talking about, that everyone's getting hot and bothered with? Would love to hear what you think 2025's submission may be. And then I also would love to hear what the last couple of years were, if you can recall, because this has been a particularly interesting time in markets.
Oh, yes, it's been an interesting time. And probably the last decade, I thought that, Amazon, for instance, was too expensive. And it turned out the IP ratio that the stock had for many years turned out to be justified. I mean, that's been an amazing company. And probably, I don't remember, but probably some years ago in the flavor of the day, I talked about some high-tech companies that had high IP ratio, and probably Amazon was there. And I don't know, perhaps Netflix also. And, they turned out they were fantastic businesses. And if you look at those companies like Netflix, Amazon, Apple, it's beyond what we ever seen in terms of world dominance and what kind of profitability they have achieved. And I must say, I didn't thought that was possible to that extent, to that level. I mean, we're talking 1 or 2 or 3 trillion of market cap today. Yes, the P ratio are a little high, but even with lower P ratio, there would still be $1 trillion market cap. So they've been a huge success. And I thought, the margin of safety was a little low in some years ago, but it turned out it was a mistake. But for this year, I talked in the letter about the cryptocurrencies and Bitcoin, and I'm more confident in this case that they're more dangerous than perhaps a high P company like NVIDIA or Amazon some years ago, because there's nothing really tangible in terms of productive asset. Most people, I think, that are investing in cryptocurrencies, they don't want to miss out something, or they hope they'll sell it to someone else at a higher price in the future, not because they'll own a productive asset. And I think usually that kind of investment has turned out in the end as poor for the ones that no one's want to say they are speculating. But I think the main difference between an investor and speculator is an investor is truly happy about owning a security for 10, 15 years, even if the stock market was closed for a year or two, just because he knows he owns an asset that is increasing in intrinsic value, and eventually the market will reflect that. A speculator is interested in selling the assets he purchased at a higher price to someone else later, and not too late in the future also. So and I always try to see, are people investing or speculating? And in the case of cryptocurrencies, I think most of them, I think they're very, many of the crypto investors are sincere. They think the asset has a good long-term future. It's just that, how do you value the Bitcoin? Is it $10,000? Is it $50,000? Is it $100,000? There's absolutely no basis in trying to assess a value there. So necessarily, you're buying in hope of selling to someone else because there's no basis to come up with some ways to value that asset. So that's why I think it's dangerous. And, there's nothing wrong with speculation. I mean, a lot of people are speculating over the years and bought something, and, people are free to do whatever they want. And, that's the beauty. And I'm a fan of the free market. I want people to be free to buy whatever they want at the price they believe. I think it's important in a democratic capitalist system that people can purchase anything they want at whatever price they want. So I'm a fan of that free market. It's just, as a money manager for other people's money, the flavor of the day objective is to point out what I believe is a little risky. And I think cryptocurrencies in general are risky investments.
What were some others of years past? I assume AI was in there at some point. I remember that back in 2007, everyone wanted the BRICS. India and China, that was like the hot topic. Any other ones stand out as particularly memorable of the flavor of the day?
I don't quite remember. I should reread the old letters.
You can do the retrospective on the flavor of the day and see how they all did.
Yeah, we could do a postmortem flavor of the day and see perhaps some I was totally wrong about being flavors of the day and turn out to be. And, I use the example of some of the high-tech names I thought some years ago were overpriced, and it turned out they were not. They were probably even bargains when you look at retrospect. But I think being prudent and having a margin of safety, I still think that's good principles.
Do you take a value approach to art, or is that just a totally different, you're like, look, actually, I'm just going to enjoy these. I'm not priced too sensitive on these things. I'm the easy money here. How do you think about it with art too?
I have a similar approach. It's not exactly the same thing as investing in stars, but there's some similarities. First of all, when I purchase a work of art, it's obviously because I love it. I think it's a great artwork. My approach is I don't want to resell it. So when I purchase something, it's in the hope that someday it's going to be put in a museum, ideally in the private museum I'd love to build, but if not, in another museum in Montreal or somewhere else. So I want to select works of art that I believe will be considered important by art historians in the future and will have a place in the museum. So there's no objective or resale. When you buy a stock, at some point you want to sell it to have a good return, and just for some, you have a target of a return.
You can put your stock certificate in the museum too. You got some of these 100 baggers. I think maybe I just keep it and frame the certificate.
But the objective is different. It's not an objective of getting a return on a portfolio of artworks. It's to own a group of artworks that I believe first makes me happy, make me have feelings of philosophical feelings that help me grow in terms of understanding the world and what the artist want to share with me in terms of communicating their emotions. So when I look at Agnes Martin, I don't have one in the collection, but she's one of my favorite artists of all time. When I look at Agnes Martin, I have a deep sense of happiness, and it's a great spiritual experience. Now, you can't always buy Agnes Martin or Mark Rothko, but the artworks I purchase, I believe in 20, 30, 40, 50 years, and I hope beyond my life will be considered important. Where I have a similar approach to stocks is that I have a limited budget for acquiring works of art, so I cannot buy everything or anything. So I have to be selective. So I try to acquire the most value in terms of artistic value for my budget. So let's say I acquire 25 or 30 works of art every year. I'll try to optimize my budget and for that amount, get the best artworks that I can find. So that's how perhaps there's some similarities with the stock market. And also, similar to the stock market, there are some trends or fashion in the art world, and some artists are sometimes very popular and sometimes unpopular. And sometimes you can find artworks from great artists that for some reason are underappreciated by the market, and you can get to what you believe is a third or half their intrinsic value. Of course, it's not the same way you value an artwork as you would value a company or other productive assets. Of course, a work of art is not a productive asset, but try to have a general view of what it could be worth. And sometimes you can acquire great artworks at a very good price.
Who's the Rothko of stocks for you? You know, you're like, I got this on my list. I want to buy it. This never gets cheap. I'm just waiting, Costco. You ever get down to a reasonable PE ratio? Are there any particular ones stick out?
Oh, yes, Costco is a good example. It's a fantastic business, and very, very sad to say that, but we owned it for 5 years, I think from 1998 to 2003 or 2004, and I very stupidly sold it because I thought the valuation was a little high, I think in 2003, and I've been a source of eternal regret since then, and of course, when you look at the valuation today at 50 times earnings, it seems to have a very, very thin margin of safety, but it's been a fantastic company to own. That's for sure.
Well, look, you get this pull of the NASDAQ up. Theoretically, if there's ever a bear market again, I don't know. I mean, we may never have one again in our lifetime, but
well, I can guarantee that there'll be a bear market in the future.
I don't know if you can guarantee, or just say a highly likely.
It's more than very likely. It's almost 100% sure that there'll be a bear market. I don't know when.
Right. So that's the key. Who knows when? It's been a long one, you know?
I think it's a waste of time trying to predict it. So yeah, just to accept it's going to be part of it. But we'll see. Well, I remember when I started Giverny and I started to have clients, I wanted to, I always kept in mind the good counsel of Charlie Munger, and said that the long-term success of marriage is low expectations. So I always tell clients that probably if they live and invest long enough, they'll experience a 50% drop in the stock market. They have to accept that probably right from the start. And, it happened in 2008 and 9. So, probably it will happen again. I don't know when, but in the next 30, 40 years, it's going to happen. And bear markets are even more common, probably every 7, 8 years, something like that. You have to accept it. And once you have accepted and you know it's going to happen, you're more philosophical about it when it happens. You were mentally ready for them. And the great thing is you can take advantage of those and buy great stocks at great valuation. Now, one argument you'll hear is that if you're 100% invested, how can you profit from the market since you don't have any cash? Well, my counter argument is that there's always relative differences. One stock can trade at, 60% of its intrinsic value, and another stock can trade at 30% of its intrinsic value. So you can sell the one that's the discount is a little lower and put the proceed into the company that is more undervalued. So you didn't have any cash, but that transaction going from a undervalued asset to a much more undervalued asset in the long run, if you're right, of course, about the true valuation, will increase the return of the portfolio. And you will have profited from the bear market.
If you were to sit down with a group of your peers, you're hanging out in Montreal, you're on a chairlift in Tremblant, you're at a hockey game behind the glass, and it's a group of CIO portfolio manager buddies. What's something that Francois would say where most of them would disagree with you about?
That's a good question. I never thought about it. I'm not that original. I have very simple ideas. I just want to find great companies and buy them at reasonable valuation and just hold on to them. And I would say that, if you talk about CEOs or entrepreneurs, or they like to find a revolutionary idea, artificial intelligence or whatever. And probably they are attracted to, what's going to be the big trend in the next 10 years? Where is the world going? And, some do see it in advance. I mean, Jeff Bezos at Amazon has done this incredible job of being incredibly insightful and having an incredible foresight. But I'm not that good in finding way ahead of others. I did sometimes have company that, were at the forefront. But, if you think about the O'Reilly or the Rorama or Visa, these are very simple businesses that, didn't really revolutionize anything. They just were very good at what they were doing in a very simple and mundane business. So probably people would think that I'm not trying enough to be a visionary. But I try. And sometimes I do find, Google obviously has done very well, and Facebook also. But, most of the portfolio is invested in very simple, boring kind of businesses. I mean, I talk about the mistake of Cintas. I mean, they're renting uniforms. So it's very, very simple business, very boring, but making a very decent buck. So that's what I like.
The belief that boring can be okay. We often say in investing, like, it doesn't have to be a unique insight. Often it just has to be the critical one, and kind of sticking to your methodology. And hey, some of the sexiest businesses can be boring. I like that, those cash flow businesses. If you look back, I mean, there's been a lot. You got to pick one, though. What's been your most memorable investment? Good, bad, in between?
Well, I talk about O'Reilly that we purchased in 2004. But I think we paid, I'm not sure, but I think we paid $20. And I think it trades at $1,300 today. So that's a 5-bagger. But sadly, we sold it probably at 400 or something. So that was a big mistake. But that has done well. And it's a very simple business to understand.
Why'd you sell it, man?
I don't know. Temporary insanity, I think. There's no good excuses. So I just thought that the growth rate was slowing and the valuation was a little demanding, but it was a mistake. And, some other companies have done well. We've owned the Orama that we purchased in 2010, 15 years ago, and the stock is probably up, 18, 19, 20-fold. So it's been a very, very good investment. I mean, Visa, we bought in 2010 also. And I don't remember, but it's probably up more than 10-fold, that's for sure. I mean, Google, we purchased in 2011 and it's done well. So, but again, the key thing is to hold on to those securities. And, those 3 examples, Alphabet, Visa, and Dollarama, we trimmed it at some point. So we did well, but we could have done much better than that. Oh, so that's one lesson. Yes, it's great to own fantastic business that grow and grow and grow, but you have to hold on to them also.
Francois, it's been a blessing to get to spend some time with you today, man. This has been a lot of fun, tour of all sorts of different stuff. If people want to read your annual letters, I've had so much fun sifting through them over the years. We didn't get to things like negative yielding sovereigns or the 100-year bond, all these other topics. We'll save those for next time. Where do people go to find out if they wanted to check out what you're up to and read some of your writings, check out some of the paintings?
Yeah, it's very simple. It's on the website, givernycapital.com.
We'll put the link in the show notes, listener. Francois, thanks so much for joining us today.
My pleasure. Thank you for inviting me.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.